Hey everyone, and welcome back to Gold Off the Charts, where we dive deep into finance every day, helping you see further and find your groove on your journey to build wealth. We want you to outlast the competition. In today's video, I know many of you feel like you're on a roller coaster, it's been stressful. Just 2 days ago, we were all celebrating watching gold blast past $4,600 and silver hitting the $90 mark like a freight train. It felt like financial freedom was finally within reach. But then, we woke up. And the market gave everyone a reality check. Let's look at the charts. Gold prices have pulled back sharply after that rally, dropping below the key psychological level of $4,600. It's sitting back in the $4,580 range. Now, that's actually tame. Look at silver, the crazy aristocrat of metals, showing its wild side once again. It's been brutal. The volatility was terrifying, with silver plummeting over 7% during the session, crashing back down toward $87. For those who chase the high, you might be trapped in a losing trade, and I know your confidence is shaken. With such a massive shakeout, my inbox has been blowing up over the last 48 hours. Many are asking, is this the top? Are we heading into a bottomless crash? Should I cut my losses and run? Everyone, take a deep breath. Don't panic. If you're losing sleep over a 2-day pullback, or if you're feeling totally lost, then you might be missing the underlying logic of this move. This isn't a crash, it's a necessary flush. It's the market cooling off after a period of pure mania. A healthy reset before the next move. Today we're going to use this deep dive video to cut through the noise and show you the reality behind this correction. We aren't just talking about price tickers, we're talking about an unprecedented power struggle and massive capital shift currently unfolding on Wall Street. We'll break down the Trump administration's war on the Federal Reserve and analyze why Wall Street is selling the US to set up for the Big Mac midterm deals. More importantly, in the second half, I'll explain why I'm still a silver bull and why I believe it's the ultimate game changer for regular people. We're using the hard data. We'll talk gold to silver ratios, industrial demand, and Wall Street's hidden agenda. By the end, you'll see why I say this correction isn't a reason to panic. It's a second chance to get on board. All right, let's get into it. First, we have to identify the source of all this market anxiety. Most people think it's just profit-taking after a big run, but that's just the surface. The real reason is a massive power struggle at the highest levels of the U.S. government. The tension between Trump and the Fed is no longer a secret. It's an all-out war. This conflict is driving up the risk premium that global investors demand for holding U.S. assets. This is a huge deal. It's shaking the very foundation of U.S. financial dominance. Ask yourself, why does the world pour money into the U.S.? It's because of the dollar's credibility and the independence of the Federal Reserve. Global investors trust the Fed to make decisions based on data, inflation, and jobs rather than politics. They aren't supposed to serve a president's personal agenda. But now, that trust is breaking. With Trump publicly attacking Powell and using the DOJ to investigate him, big money is asking, if the Fed loses its independence and the printing press becomes a political tool for the White House, can we still trust the dollar? The uncertainty from this political risk is triggering a massive capital flight. That's why Treasury yields are swinging and the stock market is struggling to find its footing. This interference creates a domino effect. Yields rise because people stop buying bonds, and stocks underperform because the fair value logic is broken. All of this confirms one specific trade: selling the U.S. So where is all that money going once it leaves U.S. assets? It needs a safe haven, a place with no political risk, no dependency on a president's mood, and a 5,000-year track record. You guessed it, gold. Look at the data, and the data doesn't lie. Holdings in the world's largest gold ETF, the SPDR Gold Trust, are steadily climbing. What does that tell you? It means while retail traders are panicking, the smart money is voting with their wallets. They are buying the dips and dumping politically charged U.S. assets, opting instead for the safety of gold. That's why gold's gravity is only getting stronger. A short-term dip won't stop this massive wave of institutional capital. This is a major cycle shift in asset allocation that won't happen overnight. Next, let's talk about the new playbook Wall Street is quietly running. They've given it a catchy name: Big Mac. No, not the burger. It stands for Big Midterms Are Coming. This refers to the political drama surrounding the 2026 midterm elections. As we get closer, Wall Street elites are bracing for serious policy turbulence. As we know, President Trump has a very unique style. His governance by social media has shown the market exactly what unpredictability looks like. He's been dropping quasi-policy statements left and right, clearly aimed at giving Republicans an edge and winning over voters for November. However, these vote-grabbing moves are causing chaos in the markets. Some might even call them a disaster. Let's look at the specifics. First, the banks. Trump recently suggested on social media that credit card interest rates should be capped at 10%. Friends, that is direct government interference in the free market. He's moving the cheese, and it's a massive piece of cheese. Bank stocks tanked immediately because their entire profit model was suddenly thrown into question. Then look at defense. Usually a safe bet, right? But the president suddenly told defense contractors to stop paying dividends and dump that cash into production instead. While that might sound good for national security, it's a nightmare for shareholders who rely on those dividends. It crushed investor expectations and hammered the sector. This policy chaos is now the primary risk for 2026. It's forcing investors to rethink their math in a market that was previously priced to perfection. Even though big indices like the S&P 500 look stable on the surface, don't be fooled. If you look under the hood at individual stocks, volatility is exploding. Individual stock swings are now double that of the index. There is a massive undercurrent of fear. Everyone is terrified their stock will be the next one in the crosshairs. Heavyweights like JP Morgan have already sounded the alarm. With the Fed under fire and policy so lopsided, U.S. stocks are in for a rough ride. We are 42 weeks out from the midterms, and this Twitter-style governance makes traditional trading strategies almost impossible to stick to. What is the market's biggest fear? It's a wildcard move from the White House that targets a specific industry and breaks the market balance. Today it's banks, tomorrow it's defense, could tech or healthcare be next? Nobody knows. These social media posts might only cause ripples for a day, but the underlying fear is contagious. Simply put, no investor wants to wake up and find their portfolio is the target of the flavor of the day attack. Seeing a stock gap down 5% or 10% at the open isn't investing, it's gambling. And history shows we should always be cautious during midterm years. With political risks redlining, many pros are turning bearish. JP Morgan's trading desk warned that U.S. equities are likely to lag in the near term. As the legal and political pressure on Powell intensifies, the risk premium for U.S. stocks goes up, meaning global markets might actually beat the S&P 500 inches 2026. So, in this Big Mac era of total uncertainty, where does the money go when stocks and bonds are too hot to handle? This is where gold's true value returns to the spotlight. As we've discussed, big institutional investors are still surprisingly underallocated to gold. Given the triple threat of overvalued stocks, policy shifts, and political drama in the U.S., gold is the ultimate sanctuary for big money looking for certainty and asset protection. These institutional funds are massive. If they shift even a tiny fraction of their portfolios into gold, the upward pressure on prices will be massive. Beyond the political noise in the States, we can't ignore the geopolitical gray rhino looming in the distance. I want to point back to the situation in Iran that we've highlighted before. The Middle East is quietly reaching a breaking point. Internal unrest in Iran, external sanctions, and friction between Israel and its neighbors are pushing the region toward the brink. The Trump administration's maximum pressure campaign is making things increasingly volatile. If a major conflict breaks out in the Middle East again, it will act as a massive rocket booster for gold. Investors will flee from political uncertainty straight into war hedge assets, creating a double whammy for prices. Now that we've covered the big picture in gold, let's get into the meat of today's video, the part I'm most excited to share: silver. Silver's wild swings over the last 2 days have spooked a lot of people. It's down 7%, and some think the sky is falling. But from where I'm sitting, this dip is a massive gift from the market makers. Why am I so bullish on silver? Why do I call it more aggressive than gold, and perhaps the best chance for the average person to build wealth? There's some rock-solid logic here you need to hear. Let's look at a simple but powerful math problem. The gold-silver ratio tells us how many ounces of silver it takes to buy 1 ounce of gold. Let's do the math. Gold is sitting around $4,600. If the gold-silver ratio simply returns to its historical average of 50 to 1, where should silver be priced? Just divide 4,600 by 50. Silver should be at $92. Right now, the ratio is sitting at 52, which is close, but keep in mind that 50 to 1 is just the long-term average. At the height of past bull markets, like in 1980 or 2011, the ratio tightened to an extreme 30 to 1, and it has even hit 15 1-inch the distant past. If we see the ratio hit that bull market peak of 30 to 1 again, how much upside is that? $4,600 divided by 30 puts silver at 153. Think about what that implies. Even if gold doesn't move an inch from here, if silver just catches up to its bull market valuation, it has the potential to nearly double. If gold climbs to $6,000, that's a solid 30% gain. That's great for big funds looking to preserve wealth, but it's not exactly life-changing for the average investor chasing high returns. But if silver makes its move, we're talking about doubling or even tripling your money. That's why I say gold protects the rich, but silver changes the lives of the rest of us. Gold simply can't match silver's explosive potential. Beyond the financial side, silver has a deeper fundamental logic. It is a consumed metal. Think about it. Where does gold go once it's mined? It's mostly turned into bars, coins, or jewelry, then locked away in a central bank vault or your personal safe. Most of the gold ever mined over thousands of years is still here. It doesn't get used up, it just changes hands or sits in a vault. But silver? Silver is a completely different story. Silver has earned the nickname industrial vitamins. It's the single most conductive metal on the planet, period. Think about solar panels, electric vehicles, AI chips, and 5G towers. None of these technologies can function without silver. With the world racing toward carbon neutrality and solar energy, demand is skyrocketing. Did you know a single EV uses over twice as much silver as a gas car? Solar panels are essentially held together by silver paste. Here's the catch. Once that silver is used in industry, it's gone. While you can technically recycle it, the cost is often too high to be worth it. Most industrial silver simply vanishes when products are scrapped. This creates a massive gap between supply and demand. On one hand, mining just can't keep up. But why? It's because about 75% of silver is a byproduct. Miners find it while looking for copper, lead, or zinc. They can't just flip a switch to mine more silver alone. Meanwhile, industrial demand is exploding. Photovoltaics, AI, and green energy are the mega trends of the next decade, and their need for silver is non-negotiable. Combine this supply shortage with the flight from a weakening dollar, and it becomes almost impossible for silver prices not to climb. Now, some of you are probably asking, if the fundamentals are so strong, why is the price so jumpy? Why did it just crash? This brings us to a topic I've wanted to expose: the market conspiracy. Look at the massive Wall Street investment banks. You know the ones? They hold enormous short positions in silver futures, essentially betting the price will drop. Why? For one, it helps them keep prices low so they can slowly buy up physical metal or exit their trades. Secondly, they work with industrial giants to keep raw material costs down. If silver stays cheap, big tech and solar companies keep their margins high. But there's a limit to how long they can suppress it. You can print paper silver contracts forever, but physical silver is finite. When industrial demand hits a certain point and exchange vaults start running dry, we see the most exciting event in finance: a short squeeze. Once silver breaks through a psychological ceiling like the $50 level we saw or the recent $80 mark, the game changes. These institutions with massive short bets face margin calls. To stop their losses from spiraling, they are forced to buy back silver at any price. Their buying then pushes the price even higher, which forces even more short sellers to panic and buy. It creates a stampede effect that makes the GameStop saga look tiny in comparison. This time, it's not just retail traders versus the suits, it's industrial giants and global central banks fighting for a dwindling supply of metal. I'm not gambling on silver, I'm doing the math. This is a high-probability trade aligned with the tides of history. This recent two-day pullback? That's just the smart money using the news to shake out the weak hands. They want to scare you into selling your bloody chips right before the real squeeze begins. If you sell now, you're walking right into their trap. Looking at the big picture, This volatility in gold and silver is just a bull market squat. The deeper the market squats, the higher the eventual jump. The fundamentals aren't just good, they're better than ever. First, the Fed's independence is being questioned, which is rattling the very foundation of the US dollar. Capital is exiting US assets at an accelerating pace, a structural shift that's hard to reverse. Meanwhile, with the 2026 midterms looming, the Big Mac trade is in full swing, policy chaos is spiking, and US stocks are looking increasingly vulnerable. Investors are scrambling for safety. On top of that, big institutions are still light on gold, leaving massive room for them to build positions. That's a huge wave of pent-up buying power. Plus, the Middle East remains a powder keg that could spark a flight to safety at any moment. Finally, the supply-demand deficit in silver and the mean reversion of the gold-silver ratio give the metals market incredible upside and aggressive flexibility. With these core drivers in place, gold is perfectly positioned for a massive run in the first quarter once this brief dip settles. For us as investors, the game plan is crystal clear. Don't let short-term noise rattle you. Don't panic just because silver took a 7% hit. In this environment, volatility isn't a threat, it's an entry point. For those of you waiting on the sidelines, this pullback is your golden ticket to get in, especially with silver. If you're already holding, stay the course, keep your conviction high, and don't let the smart money shake you out of your position. Resist the urge to overtrade or chase small T+0 gains, because if you sell now, the market might move so fast you'll never get back in at these prices. 2026 is the year of hard assets. It's gold's time to shine, and it's silver's time to stage a massive comeback. As always, a quick reminder, these are my personal views. This analysis is based on my deep dive into current market data, news trends, and economic logic to help you cut through the noise. It is not financial advice, so always do your own research. That's a wrap for today. If this deep dive helped ease your market anxiety or gave you a fresh perspective, drop a comment below. I'd love to hear your take on where we're heading. Don't forget to hit like, subscribe to Gold Off the Charts, and share this with your fellow traders. Stay steady, and I'll see you in the next video.